Once I select the expiration month, then I have to decide on the strike price. And there's, like I said, for Apple, there's over 400 options available, 400 choices with Apple. So you have to kind of narrow that down. Yeah, here's an example. If you're going to trade the Apple July options, there's 55 different strike prices for the July options. Options consist of time value and intrinsic value. And as we said, when the option expires, it loses all time value. And it only consists of intrinsic value. So when you buy an option, you want to maximize your intrinsic value and minimize the time value. The deeper an option is in the money, the more intrinsic value it will have. Out of the money and at the money calls have no intrinsic value, only time value. So the time value of the option is a decaying asset, therefore you want to maximize your intrinsic value and minimize your time value. This first example is an out of the money option, and this is simply a quote from Yahoo Finance. We can see that Apple stock, the stock is trading at 173.25. The 185 call option is trading at 315. If the strike price is above the stock price, it's an out of the money call. So in this example, if we buy the 185 strike for 3.15 points, Apple stock has to increase to 188.15 to just break even on this trade. So if it goes from 173.25 to 188.15, that's an 8.6% increase in price. Now this is a 1 month option. So over a 1 month period, Apple stock has to go up 8.6% just to break even on this out of the money call. So now let's assume that we purchase an out of the money call similar to the one I just showed you each month on option expiration day. In other words, February option expiration, we would buy the 1 month March option. And in March option expiration, we buy the 1 month April call. So if you did that for a year, and it was similar to the one we just showed you, by looking at this 1 month price change, we can estimate how many of those trades would be profitable based on an 8.6% increase in price to break even. Using our historical data, if you needed an 8.6% price increase to break even in 2007, you'd have approximately 6 profitable trades and 6 total losses. January 2007, you would have had 100% loss. February, you would have had 100% loss. March, 100%. May, June, July, you would have been profitable. This demonstrates that trading out of the money options is it's a very low probability of success based on this. And keep in mind, it only takes one of these 100% losses to wipe out everything. So, so trading out of the money options is very high risk and very low probability of success. In 2006, you would have had 2 profitable trades and 10 total losses. So it just shows you that with out of the money options, it's very hard to make money. Now I have a general rule of thumb for selecting the strike price, and you want to purchase options with a time value of less than 1% of the current stock price per month. So if you purchase an option on a stock that's trading at 100, you want to limit the time value of a 1-month option to 1 point, because that would be 1%. If it was a 6-month option, you'd want to limit the time value to 6 points, because 6 points is 6% of 100, and it's 1% per month. So the idea is to limit your time value to less than 1% a month. And if you do that, you're going to have a much higher probability of success, because if the option only has 1% time value, that means that the stock only has to increase 1% to break even. So you're going to have a much higher probability that you're going to be profitable if the stock only has to go up 1%, as opposed to 8.6%. So trading in the money options allows you to increase the accuracy of your options trading compared to out of the money options. So again, as a general rule of thumb, limit the time value to less than 1% of the stock price per month. Okay, now we're going to look at an in-the-money example. And this quote was taken at the same time that I took the out-of-the-money quote, and Apple's trading at 173.25, and the 150 strike call cost $24.60. With Apple trading at 173.25, if you subtract the strike price 150 from the 173.25, you come up with the intrinsic value of the option. And in this case, it's 23.25 points of intrinsic value. So if the option costs $24.60 and the intrinsic value is $23.25, that means the time value is only 1.35 points. So you're not going to lose much in time value with this option purchase. Okay, so in this example, Apple stock only has to increase 1.35 points, or 0.7%. So less than 1% for this trade to break even. So obviously, if it only has to go up 1% versus 8.6%, you're going to have a much higher probability of a profitable trade. That's important because if you buy out of the money options, you can't use our money management rules of exiting an option if it goes down 20 or 30%, because an out of the money option, it could be down 50%, just with a small price decrease in Apple stock. So you can't use our money management rules with out of the money options, but we can use it for in the money options. With Apple trading at 173.25, if the time value is only 1.35, the stock does not have to go up much for you to profit. And at the same time, you're still going to realize a good return. If the stock goes up 10%, you're going to have a 64% return. If the stock goes up 15%, you're going to have a 100% return. So you can have a good return even though it's deep in the money.